Well, good morning, everyone. Thomas Montgomery here. It is a beautiful Tuesday morning. Today is July 29th, 2025. It's 8 o'clock Central. We get together most weekday mornings at this time, talk about strategies, tips, techniques, share success stories, and support each of you. As a 501c3 nonprofit, we've received a grant. The grant has three mandates. Number one, to improve financial literacy. Number two, to give away free shelf corps. And number three, facilitate the access to capital from numbers one and two, the education and the shelf corps. Each day we try to bring forth content that is relevant and practical. Yesterday we had a really good conversation. If you missed yesterday's training, strongly encourage you to go back to our YouTube channel and view it. Today has two levels of conversation. There's what's on this page that we're going to go through, and it's important. There's a few things that I want to say that I can't put on paper, so you might have to infer, wink, wink, as I go through. But if you understand this topic, which is asset-based lending, it is a remarkable tool, both as advertised, but then as we look behind the scenes, how it can be used. But let's go through the face value first, and then we'll talk about maybe some hidden nuggets that might not be so apparent to you. So today we're talking about asset-based lending. If you need our website or support line, this is where you text. It's not answered live, it's a text support line. All right, introduction. When it comes to business funding, there are different types of loan programs. Like yesterday, we talked about private credit. Each of these loan programs have their own underwriting criteria. So this is an incredibly important sentence because a lot of people, they don't realize that there's different types of money sources, and each one has its own underwriting. Thus, it's not accurate to ask a question, well, what credit score do I need? Any question that is so specific can't be answered because it's dependent upon which source of funding they want an answer to. So, what we do know is that traditional business loans, which is not what we're talking about today, nor what we talked about yesterday with private credit, but traditional business loans, whether it be directly from the bank or through the SBA, typically focuses on what we call the three C's. And we spent a lot of time in the past educating on the three C's: credit, collateral, and capacity. But the truth is that there are some sources of funding that only focus on one of the three C's. There are some that only cares about credit, not collateral, not capacity. Some only care about collateral, which we're going to be talking about today, and then some only capacity. So we're going to actually be focusing on how we can help anyone get funding regardless of their credit, regardless of the capacity, focused on collateral. And we're going to call that, which it's called in the industry, asset-based lending. So asset-based lending, ABL, it's a type of financing where a company borrows money using their assets as collateral. Now, I'll stop there. I know a lot of you are saying, well, sure, but a lot of your clients may not have much for business assets. And if they're getting a shelf corp from us, it's not a real thick balance sheet, right? It's rather minimal. But that doesn't mean that we can't legally and ethically transfer whatever amount of assets that's needed so they can qualify. So I don't want you to look at ABL and asset based lending and ever think that someone can't qualify. Anyone can qualify because we can legally and ethically manipulate their balance sheet to have enough assets. And again, when I say manipulate, I'm not saying anything gray or improper. Just we can add assets. So, in essence, the lender with ABL focuses primarily on the value of assets when assessing, or what I would say, underwriting the loan, rather than focusing on other things like the other three C's. So, instead of focusing on credit, or capacity, they're focused on collateral. So this is real, this is mainstream, you can research it and see, but we have kind of mastered the approach of how to access asset-based lending, ABL, which we're going to go into more. Now, what we normally do not do is use ABL for small capital raises. It doesn't work because the lenders that are focusing on ABL don't want to go give an itty bitty loan. So typically we're looking at 1 million or above if we're going after an ABL. You might have had clients in the past that had issues. You might wonder, well, why didn't we bring up ABL for them? Well, if what they told us on their uses of funds is that they're looking for a small capital raise, then it's not a good fit. $1 million plus. I see Ben's asking, is there a maximum? No, there's not a maximum, but there is a floor. We don't want to do ABL for any client looking to raise less than $1 million. All right, so let's talk about the benefits. Now, on the benefits, I'm able to put in writing 4 of these. There's a 5th bullet that's not here that I'll infer, and it'll blow your mind, but we'll get to that. So what are the stated benefits of ABL? Well, first of all, it's more accessible. Just for the reasons we said, ABL can be easier to obtain. Well, why is that? Because these types of loans are focused on one of the 3 C's, not the others. That makes sense, right? Also, another benefit is faster approval and funding. Because we're limiting what the underwriting is considering, they only need to consider one of the 3 C's. They don't have to spend time evaluating the others. So it's easier for them to underwrite, it's faster for them to approve, and it's quicker for them to fund. Flexibility in the use of funds. And this is going to lead towards my 5th bullet, which isn't here because I can't put it in writing, but I'll give you a verbal explanation. So what could you use ABL for? Could you use it to buy a business? Could you use it to start a business? Could you use it to buy real estate? Yes, 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 yes. There's no restrictions on it. Could it be for a high risk industry? Yes. Essentially, it can be for anything. It can be for anything. What if you wanted to go borrow money just to pay off your personal debt? Yes, anything, anything, because it doesn't function like a normal business loan. Also, we have higher borrowing limits because as long as our collateral supports it, we can borrow more and more. So, to no surprise, lenders want to be repaid, and who knows what will happen in the future. But if there's collateral that's pledged, then it mitigates the risk. So, it is true, and I think this is what Mark's picking up on here. The larger the capital raise, the more collateral we would need. Kind of makes sense. And in fact, we went dollar for dollar normally. So if we wanted $1 million capital raise, we're going to need $1 million of collateral. And again, if you're being short-sighted, you say, oh, well, shit, this isn't going to work. I don't know if any of my clients have $1 million of collateral. You're missing the point. We can transfer $1 million or more of assets legally and ethically to any of your clients. So no, we can't use the excuse that the client doesn't have it. It's only if they don't want it. All right, so now we're going to get to this very sensitive bullet number 5, which is not here. So I'm going to make a very loose statement, and you can draw your own inference. So let's say, let's look at all the great people. We have 539 of you on today. Let me pick someone out as an example. Let's see here. We have Mr. Barker. Mr. Barker's a big hitter. So let's say that Mr. Barker wants to buy real estate, but he doesn't know which real estate yet. You know, he needs to have the money in his pocket so he can go make an offer and has proof of funds. Well, if we were to use real estate financing, that's a problem. Because for real estate financing, we need to know the address, we need to have it appraised before Mr. Barker can have financing for that piece of real estate. Here, what did we say? This can be used for anything. So we could go use an ABL, go pull together enough, and then what could we do? We could buy, which is not the fifth bullet written, but Mr. Barker or anyone else could go buy real estate as a cash transaction. Well, that's powerful, isn't it? So that's true. If we just wanted cash on hand to be able to buy a business if it comes up, we don't know what yet. Because again, for normal financing, we need to have the three C's, and we would need to tell the lender, hey, we want money to buy ABC company, and we would have to get ABC's financials to show the lender that it qualifies. Here we bypass all of that, so we're getting an ABL, an asset-based loan, and then that money can be used for anything. But the deeper point, let's go back to Mr. Barker. So let's say Mr. Barker wants to buy real estate. What if he wanted to buy real estate and own the title free and clear? No lien against it. Well, with real estate financing, that's not possible, right? Because the real estate loan is going to use the real estate as collateral. But what if Mr. Barker went and used ABL? So we would use two different companies in this hypothetical scenario. We would use the Shelf Corp to go get the ABL, and then it would have the loan, it would have the collateral, which we'll provide, it would have the loan that it owes back. So his Shelf Corp owes the money, but then he would have a separate company that actually has the property deeded in its name. So the real estate is not pledged as collateral. If in the unfortunate circumstance that Mr. Barker's Shelf Corp couldn't pay this back, it might default on the loan, but would the lender come for the real estate? Probably not, because the real estate's not owned by the same entity. So if you're reading between the lines, this is incredible. We can help the client get the funding through the Shelf Corp, and then they can transfer that to a separate company to make the purchases, and the collateral is part of the Shelf Corp, whereby if there's a default, whatever is purchased is not at risk for repossession. Are you following how big of a deal that is? So what if you went out and you wanted to buy single family homes and be a landlord? So could we go out and buy 1, 5, 10, 20, 100 homes? Yep. Would we have to have any liens against those mortgages? No, not using this strategy. What if you wanted to kind of layer in? So let's use another example. Let's take Steve, Mr. Pope. Let's say Mr. Pope wants to do that. He wants to get 10 houses. Okay, great. What's the average purchase price of each house? Let's say 200,000. So we need 2 million of funding through ABL. So we get him 2 million. He's sitting on 2 million cash, and then he purchases 10 real estate properties at 200,000 apiece. What's the lien against those real estate properties? Zero. He owns them free and clear. What does it mean then if he owns them free and clear? He could turn around and borrow off of those assets if he wanted, because he owns 100% of it. So we can get really clever, really creative when using two different parallel entities. One that's getting the ABL, and then the other one that's acquiring the assets. Does that make sense to anyone? Anyone's light bulb going off of how strong, how strategic it is to separate the entity that has the debt versus the entity that owns the assets? Crazy good. Crazy good. All right. So let's talk about the steps, because we always want to be practical. So what are the steps? Oh, I should have changed this. Sorry, I used the template from yesterday. Ignore that. I'll hide it. So we're on the steps to get ABL. I should have changed that title. So we're on steps to get ABL, asset-based lending. Well, first, of course, we need to start with a loan package, and the loan package comes with the Express Shelf Corp. So that's not a problem. We're going to provide the client an entity that's in good standing at the state and federal levels. We'll have a good bona fide commercial address. So all of that's included, the business plan, the use of funds, and financial projections. Now, I realize that in some cases the business plan or the amount of funding doesn't match what the client wants because this is kind of a business in a box. No worries. Down here, we'll make any changes needed. So here we get the client a business in a box. So if you're a reseller or a branch office, we give away shelf corps. They're just paying a processing fee. You determine how much the processing fee is. You make money on the front end. Client gets an express shelf corp. Great. Step one. Simple. That's what we always do, right? So that's not a change from our normal operating procedure. Now, number two, we're going to have to add a new step. We're going to need to transfer assets, and they're going to be in the form of accounts receivables to the client. Well, why do we need to do that? Because we're leveraging asset based lending, which means it's collateral based, which means we need enough collateral to qualify for the capital raise. And we don't expect most people will have that. Therefore, we're going to need to transfer that. So we'll work with the client. We'll understand what they want their use of funds. In other words, how much cash on hand do they want? And then we'll be able to get them the assets that they need. Real, legal, ethical. Now, it's even better than that. What we're going to do is then liquidate. So we have a couple sister entities, but one of our companies is a licensed, bonded, and insured debt collection company. No one likes the debt collector, right? But regardless, so then we can turn around and liquidate these assets because these assets are always going to be accounts receivables. You might say, well, how come? Why don't we use some other asset? Because accounts receivables are an exception to the rule. It's a loophole. It's one of the few bona fide, credible business assets that we can get for pennies on the dollar. And with that, then it's real, so we can actually go collect that money. So we're licensed, bonded, insured, as I mentioned, to liquidate those accounts receivables. Well, why would we want to liquidate accounts receivables? Well, two reasons. Number one, it's real and we want to create a stream of cash flow, which shows as bank deposits going into the bank. So it's real money coming in. But it's also going to be important to qualify for ABL. It's naive to think that we can go suddenly add, let's say, $1 million of assets to a client's balance sheet and then not show the lender that it's real, that we actually are liquidating it. So this is a necessary step as well as a beneficial step. Once we've done that, then we go to step number 4. And as I alluded to before, if the basic shelf corp does not meet what the client wants or needs, then this is where we're going to go in and make the edit. So if they want to alter the business plan, they want to alter the name of the business, the use of funds, so forth. But again, as we mentioned, frankly, use of funds is least important for ABL because they're unrestricted. So then we're going to apply for ABL, asset-based lending, and then the client receives their funds. So let's use an economic example. I think some of you are visual learners, and if you understand what I'm covering right here, I think you'll agree with me. It's an amazing strategy. So if a client comes to you and they want $1 million capital raise, they want $1 million of debt. They want $1 million loan. So that's number 2. That's kind of a given, right? But with the ABL, we have a whole nother benefit. So if we're going to provide $1 million of assets to qualify for the $1 million loan, so now they have $1 million of assets in the form of accounts receivables. What did we say earlier? We're going to liquidate those. So when we liquidate, it means we're going to collect the money from the debtors, and the money is going to go to the creditor, which is your client. So we will take that responsibility. It's not a burden. There's no work, no effort. Just like we've talked about the OBD, the outsourced business development, that's a hands-off way of generating client income. This is a hands-off way of generating another type of income for clients, whereby they don't have to do anything. And best of all, we're paid as a licensed, bonded, insured collection agency off of collecting the money. So we have an aligned incentive. So you could even say, well, if we did this, the loan becomes quote unquote free. What do I mean by that? Well, if we have $100,000 loan and $1 million loan and $1 million of assets, and if we're going to go collect that $1 million or as much as we can of that, the money that comes from this can pay the payments on this. So literally, you're positioning the client to get a free loan. It's not free, but the liquidation of the receivables theoretically could pay for it. So each month, when there's a payment due on that $1 million loan, the money theoretically could come from the collection of the AR. So it doesn't have to come from their operating budget. Do you see the value there? All right, so wrapping it up, and then we'll get to we'll get to Q&A. So our 501c3 nonprofit received a grant to assist small businesses in qualifying for funding. With no risk to you, we'll provide a fundable business entity, help you build a loan package, and our guarantee for funding's in writing. So let me scroll up and let's see what questions any of you have regarding ABL. Do any of you have experience in asset-based lending in the past that you might be able to contribute? I think this is one of those concepts that's been out there, but a lot of people have not had the process in place to leverage. And of course, you have to have the collateral. For asset-based lending, we need the collateral, and we provide the collateral. That probably makes us unique, doesn't it? All right, Selena says this is great, especially for real estate. Agreed. Frankly, why would anyone want to buy real estate outside of this model? Because there's only two options to buy real estate in general. You either go get a real estate loan, and now that means you have a lien against that real estate, or you use ABL to buy the real estate, and you have no lien against that real estate, which protects your investment. Plus, if money got into a pinch, you could always borrow against that real estate because you own the deed free and clear. Crazy good. JC's asking about the process. So let's go back down here. So we'll work with the client. So again, when we have these educational sessions, we're not trying to shift some burden of work to each of you. We just want you to understand some of the strategies that are available. So from your perspective, JC and others, all you need to do is go give away shelf corps and we'll take care of the rest. We'll work with them on getting the assets they need, on the liquidation of the loan package and getting the funding, and then you'll be paid 5% of that. So don't overcomplicate this. I know you could argue, well, Tom, why are you even talking about this if you don't need it to do anything? I want you to know the background. So you might have some deals, especially in the real estate space or business acquisitions, that this is a gold mine for. All right, thank you, JC. Let's see. Selena says it's amazing. Tram says genius. Thank you. Selena says she'll be promoting this. Yeah, and again, you got to be careful because really what you're promoting is a shelf corp. The shelf corp is the shelf corp. It doesn't change. This is what we call phase one. When we go into phase two, that's where we're figuring out what they want, how much they want, and then how to structure the capital raise. But you're right. If they're looking at a large capital raise in general, real estate, business acquisitions, or just use of funds that's difficult to get normal bank financing, this is our go-to resource. All right, so let's see what else we have here. If you have any questions, comments. Ben asked about from the collection perspective. So we have a licensed bond and insured collection agency, which I've said I think 3 times now. So we'll take care of liquidating the debt. The way that it works is we're going to go collect, in this example, $1 million of AR, but we add the cost of collection and legal fees on top of it. Because Ben's a pretty sharp guy, so he's thinking, well, a very sharp guy. So he's thinking about, well, how are we paid as a collection agency? Well, we add our cost on top of what's owed to the client. So we're not going to go after each debtor for what they owe. We're going to go after them for 2 times what they owe. And then we have a law firm that we work with that will do the garnishments, the sheriff's sale to liquidate the judgment. So I don't want to get you too bogged down in how the process works. It's not your burden, it's not your responsibility, but we'll take care of this. And we've made some significant changes. That's why we really haven't promoted this so much, because as of August 1st, or the following Monday when we come in from the weekend, August 4th, we're going to have a brand new, well, a new iteration, an improved approach to liquidating debt that makes this a great time for you to start promoting and start enrolling clients that's going to leverage this. All right. So that was that. Let's see. Michael says things are getting better and better. He signed his first client yesterday. Great, great, great. Okay. So anyone else have any questions? If you need general support, this may not be the right place because we have 541 people on. Probably don't want to hear about your personal or client issues. Best thing to do is to text the support line, 903-347-8042. If we can respond and address the question via text, we will, or we can call. Questions, comments, concerns? Looks like Mike's asking. He's not a distribution partner, but wants to become one. Super simple, Mike. You go to 509pacific.org. At the top of the page is information about plugging in to get a free shelf corp. That's not what you asked. Below that is information about becoming a distribution partner. You can become a reseller. It doesn't cost you a penny. Just check that box on the inquiry form. Or you could be running a branch office, and with the branch office, that has some extra perks. But there's training. So go, Mike, and anyone that needs more background, either go back and view prior YouTube trainings and/or go to 509pacific.org, please. But specific questions, text us. I think we covered everything. So this is a really big deal. As you're looking at your month of August and deciding how many clients are you going to help, how much money are you going to make, this could be a very important arrow in your quiver. I'll close on this because it's the point that Toby's making. This is going to help you attract higher ticket deals. So instead of an average of 100,000 capital raised, what did we say? These are all going to be at least $1 million. So if you're making 5% off the capital raise, would you rather make 5%, which is Toby's point, off of 100,000 capital raise? Or would you rather make 5% off of $1 million plus capital raise? I suspect you would rather make 5% off of $1 million plus. So now you're making at least 50,000 a pop. That adds up. And again, I know a lot of you make so much money that I can't wow you. You take Tram on here. 50,000 is not going to change his daily budget. But for most of you, an extra 50,000 a deal, especially if you're doing the average of a deal a day, the way our average distribution partner, if you take 50,000 and multiply that times 30 or even 20 with just weekdays, those are some big numbers. The way that we do that is we deliver for the client the capital raise that they need, but with ABL, we can get them so much more capital because we're leveraging one of the 3 C's. And while they may not have the collateral themselves, we can transfer that to them so they do qualify. All right, thanks everyone. We'll see you back tomorrow morning. Let us know if we can do anything for you. Bye-bye.